Well, good afternoon. Happy Friday, September 17th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. What an interesting week it's been, and especially how it's finishing out, with all eyes expecting the Fed to start tapering here sometime in the next couple of months. Let's take a quick look at mortgage-backed securities, and then we'll talk about that tapering. So here's we are. This is our Candlestick Chart. Familiar if you've been watching this series that we publish every Friday. So red days are bad days. That's where interest rates are increasing. The associated security that the interest rate is pinned to is decreasing. So as the security sells off, interest rates go up. And you can see just this back and forth for the past 30 days until the past 3 days. We've seen a consistent sell-off in mortgage-backed securities over the past 3 days. Why has that happened? Well, we got some news. Let me scroll down the screen here. We got some news about inflation, which is bad for bonds, that retail sales were up over expectations. We thought they might decline a little bit. They came in a little bit hotter. If you exclude autos, they came in a little bit hotter than what the expectations were. You know, really, that's not a crazy number, but unfortunately, it spelled bad news for bonds. Really, I think what this is just the market getting into position for the potential for the Fed to taper their mortgage-backed security purchase program. So the Fed's been buying up $40 billion per month in mortgage-backed securities since the start really of the pandemic, and that's helped to keep interest rates low. But the Fed has been talking more and more about tapering its purchase program due to inflation, even though it's short-term inflation, at least per the Fed. It's transitory inflation, but the numbers keep rolling in month after month. That inflation is a growing concern, at least in the short run, and that's leading the Fed to think, well, maybe it's time to taper the purchase program, allow rates to climb a little bit to slow down that inflation. Let's take a look at when the Fed's meeting. So here's the Fed meeting calendar. We can see next week, September 21st, 22nd, with the policy statement coming at 2 p.m. Eastern time on Wednesday the 22nd. They meet again in November and then again in December. Now, the interesting thing about the next two meetings is we also have a budget deficit or a budget issue. We're running into the ceiling on the budget for the federal government. And the federal government is slated to meet to try to come to terms on what we're going to do if the country runs out of money. Of course, it's going to come down to the wire. It always seems to come down to the wire. That's putting the Fed in a little bit of a difficult position because it's a difficult time to start tapering on their mortgage-backed security purchases right when the federal government is taking us all to the brink of maybe a potential government shutdown or at least slowdown. So that's an interesting game for the Fed to play. And then we got some other news this week, which really is interesting as it pertains to where we're headed long term. And this is about the flattening of the long-term yield curve. So really what we're talking about here is the difference between the 5-year yield and the 30-year yield. And as this starts to flatten out, we start to see that most investors are thinking long-term inflation is really not going to be an issue. As that yield curve tends to flatten on the long side, we can usually expect a potential recession, interest rates to drop, and that's what's been happening here. Let me go over here to this headline from Bloomberg, flat yield curve, and you can see if we come down here to the screen, you can see right here over the past maybe couple of months, we've seen this flattening of the yield curve between the 5-year and the 30-year treasuries. All that really means is that long-term inflation does not appear to be a concern for investors. As a matter of fact, investors are concerned long-term about the ability for growth with all of the global gravity of debt that there is out there. So in the short run, what we can expect is interest rates to creep a little bit higher in anticipation that the Fed's going to start tapering their mortgage-backed securities purchases here sometime in the next 30, 60, 90, 120 days, somewhere in that ballpark. That's what's happening in the short run. But in the long run, what we might be able to expect here as we get into 2022, potentially 2023, is are we going to see interest rates tick back down once this transitory, this ephemeral inflation bubble has moved through the system and we're back to more normal times? It'll be interesting to watch it play out. If I can be of any assistance to you, please don't hesitate to reach out. mark.milam@highlandmtg.com. Thanks.